In this episode, we cover the most important question to ask when determining a down payment for your next home. Let's get started. From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. Hello and welcome to another week, another episode. I hope that you are enjoying or have enjoyed your week thus far. We are getting into those dog days of summer where you have your summer routine and things start to settle into focus. Summer camp has started in the Harrison household, so I'm able to actually get back to doing a little work without our little one in the household. And I hope that the same is true for you, but you're also getting to enjoy the warm weather a bit. In this week's episode, I wanted to go back and kind of touch on a few different topics that we've covered briefly on the New Money, New Problems podcast. And the reason that I'm going back to the well today has a lot to do with the season that I'm in, or several of my clients are in, and that season is the home buying season. Not necessarily people having homes flying off the shelf, but more so things may have settled down a bit at work. You're in a slower season and you start looking around at properties. The weather's nicer. You see people enjoying their yard. And over the past several months, I've had several clients who have said, hey, we're thinking about selling. We're thinking about buying. We're thinking about moving sometime this summer or towards the end of the summer before school starts. And they're asking questions about the structure of their loan. And a huge part of that decision is how much do we put as a down payment? And this decision is huge for several reasons. The first of them being you typically, when you move into a new home, are moving into a bigger or more expensive home than you were before. And when you move into a more expensive home, there is often a huge fear as to whether or not you can make the mortgage payment and the expenses that come with that property. So if you're going to a new property and that mortgage is $1,000 a month more or $2,000 a month more, and you have more square footage, which means that there's more things that could go wrong, there's more to maintain, naturally you can have some concern, even if you're being paid more, about whether or not you can handle that additional expense. Unfortunately, one of the few tools you have at your disposal to lower that concern is the amount of down payment you put on the property, because obviously the more you put down on the property, the more you can help lower that monthly payment when it comes to your cash flow. And as a result, most people's natural inclination when they're about to take that leap is I want to put as much of a down payment down as possible so that I can have the lowest mortgage payment as possible, right? I want to make sure that this payment is as close as possible to the payment I just came from, which isn't very realistic. There's a reason that you're going from one house to the next. You don't just get an extra 1,000 square feet for the same price that you paid before, but it's just the natural thing to be concerned about. And in this scenario, I don't tell them what to do, but I do tell them to consider putting a significantly smaller down payment. And the reason is, from experience, I can tell you, both personally and with clients, that once you put a down payment on a property, you cannot get it back without borrowing your own money back. Whether that's a cash out refinance or a home equity line of credit, if you're trying to dip back into your home to get funds out of that property after you've closed, you're doing so by taking out new debt. Whereas on the front end of that property, if you put as small of a down payment as you can and you keep as much in your coffers as possible, you now have access to those funds without having to go back to your lender. And I'm sure you can imagine that when I tell people this, hey, I know you're thinking about 20%, but let's have a conversation about 10%. I am, in many cases, met with extreme concern, even more so than the concern of taking on higher expenses, because they're feeling like, man, Brenton might be leading me astray. I don't know how I feel about this. And they cannot see the benefits of what I'm talking about. It's not right in front of them. If you're about to take on a new mortgage payment, it's right in front of you. You're about to pay more now than you would have if you just put a little more down. But you don't have the ability of being 5-10 years in the future, having those extra reserves that you decided not to put on the down payment and seeing how those benefit your finances down the line. So I don't push people to agree with me or disagree with me. I instead tell them to ask their lender the most important question, in my opinion, that you can ask when determining your down payment. And that question is, Can this mortgage be recast? RECAST. And to understand mortgage recasting, we first have to make sure you understand the concept of an amortization schedule. You see, when you sign up for a mortgage, or if you had a mortgage in the past, you might understand that the payment that you make doesn't change, at least in terms of the amount that's needed to pay the principal and interest. So the same payment that you're making for the principal and interest in month 1, if you have a 30-year loan, is going to be the same payment that you make in month 360. The way that it works is, in the early parts of your mortgage, the overwhelming majority of what you pay is just covering interest. There's almost no money that's going to pay towards the principal. And then towards the end of that 30-year mortgage, the overwhelming majority of what you're paying is actually paying off the principal, but the payment itself never changes. Well, how does that work? It works because when they calculate what you're needing to pay, they know exactly how much interest and principal are going to be paid off with that first month's payment, and they know exactly how much you need to make sure that all of the principal is covered in full by the end of that 360th month, and it's all laid out on a schedule called an amortization schedule. If you're looking on screen, we're going to be using the same example throughout this episode. We're going to take a person who has a $500,000 home that they're purchasing, and they're trying to decide whether they're going to put a 20% down payment on that home, which would be $100,000, or a 10% down payment, which would be $50,000. And in this case, they decide to do a $50,000 down payment. They could have done $100,000. They decide to do $50,000. This leaves them with a mortgage of $450,000 for 30 years. And we're going to assume that they take out this loan 10 years ago in June of 2016 at an interest rate of 6.75%. Now you can see that in that first month, their monthly payment is $2,919. And let's look at what it does in year 1. In the first year, you can see that of that amount, almost all of it is going to pay down the interest. In month 1 of that $2,900, over $2,500 of it is just paying the interest, and only $387 and some change is actually reducing the principal of the loan balance. Now, conversely, let's look 10 years down the line. 10 years down the line in June of 2026, now there's still a significant amount of interest, $2,100 a month, but now almost $800 a month is actually paying down the principal each month. How does this apply to mortgage recasting? Well, the whole point of an amortization schedule is that at different points throughout the journey of your loan, the amortization table has an assumption for how much you'll owe at that point in time. As an example, for the $450,000 loan that we started in June of 2016, 10 years later, the amortization schedule assumes that based on the payments you've been making, you would owe $383,854.50. That's a very exact number, and it plays into the amount that they ask you to pay on a monthly basis. Now, let's assume that instead of owing that $383,000 and making the payments as intended, that you came at some point down the line and made a $10,000 lump sum payment towards your mortgage. Well, in that case, you would be getting ahead of the amortization schedule. They assume that you'd be making the exact same payment every month, but by giving them such a large extra payment, you now owe significantly less than they expected at this point in time. Now, the positive to that is if you decide to keep making the exact same payment, you'll pay off your mortgage faster. But what if you didn't want to pay off your mortgage faster? What if you made that $10,000 lump sum payment, but instead of trying to pay off the loan faster, you wanted to lower your monthly payments moving forward? Well, you can do that by recasting your mortgage. Recasting means that after making a lump sum payment, you can go to your lender and you can ask them, based on the fact that I'm ahead of the amortization table, how much would it take now to make the same payment every month and pay off that loan on the same schedule that I had before? So your lender changes your amortization schedule, recalculates your payment, which lowers your payment, and allows you to make that lower payment for the remainder of the loan. To see this in action, let's go back to our example and recall that this person was buying a $500,000 home, and they could have put $100,000 down, but they decided to put $50,000 instead, which means that they still have the remaining $50,000 in reserves. They sign up for the same loan in June of 2016 for $450,000 at 6.75%, and you'll recall that their monthly payment is $2,918 per month and some change. But now let's assume that that 10 years into that loan in June of 2026, they change their mind and they decide to put that $50,000 they had in reserves down on their mortgage as a lump sum payment. And they then ask their lender to recast the loan. Well, you can see that while their payment was originally $2,918, that large payment allows them to recast their loan and lower their payment to $2,537 a month, a monthly savings of $380.94. They then make this payment moving forward, and absent them making other lump sums in the future, they'll be able to not only save that $380 a month, but pay off this mortgage on the exact same timeline that they had previously planned. This makes the question of can I recast the mortgage an important one because it gives you the option of preserving your reserves. If you decide to use them for the down payment on the front end, it's gone. But by preserving the right to recast your mortgage down the line, you keep your options open, which in my opinion is the best of both worlds. Now, that doesn't mean that people always agree. It doesn't mean that they don't have extra questions. So after the break, I'll not only tell you some of those questions, I'll tell you some of the counter arguments that people make and things that you should consider to determine whether recasting is the right thing for you or if it's actually better to just make the larger down payment.
This is the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. We'll be right back.
Are you wondering what new money problems you might be overlooking in your financial life? If so, we've got great news. We've crafted the New Money, New Problems Gap Finder to identify potential weaknesses in your finances in areas ranging from budgeting, investments, insurance, and even the threat your extended family's finances could pose to your household. Please head to newmoneynewproblems.com/gapfinder to complete it today. Again, that's newmoneynewproblems.com/gapfinder to take the assessment.
You're listening to the New Money, New Problems podcast. Subscribe now at newmoneynewproblems.com. Welcome back.
All right, what are some of the counter arguments that people make or the concerns that people have? Well, the first one is if I don't put a 20% down payment on my property, then I have to pay PMI on my home loan. Now, we did an entire episode on why I don't think PMI is as devastating as most people think, and I'm not going to rehash the entire topic. But in summary, I will say, while PMI can be something that's annoying, you want to have an understanding of just how high your PMI payment will be in comparison to what you're saving by not making a 20% down payment. What most people don't understand with PMI is the amount that you pay each month is not the same for everybody with the same home. It's based on your credit score. So if we use that example for the loan that we've been examining, a $450,000 loan at 6.75% over 30 years, someone with an excellent credit score is going to pay $173 a month in PMI. Now, is that no money? Absolutely not. But remember that in exchange for paying PMI, they're keeping $50,000 in reserves by not making the larger down payment. So I would ask you, would you rather give someone $50,000 you can't readily get back or save $173 a month? Many people would decide to keep their $50,000. The next question people have is, yeah, it sounds good on paper, but I'm just really concerned about all these extra expenses because not only is the mortgage payment higher, but now I do have PMI on top of that. So maybe it's actually $500 or $600 a month more in this example that the person would be paying. And that is true. Now, what's my counter argument to that? Well, you may not like it, but here it is. In the scenario that we're talking about $300 to $400 a month. And if you're getting a home of that size and $300 to $400 a month is the difference between you being able to afford the home and not being able to afford the home, I would argue you already can't afford that home. Is it because $400 is no money? Absolutely not. But it's because if you are that close to the line with your budget, you're likely ignoring the other things that come with that property that were going to push it out of your budget anyways, like home maintenance or repairs, or the fact that every once in a while your homeowner's insurance is going to go up or your car insurance is going to go up. So by playing it so close to the line, I would argue you either need to stay put or you're looking for homes that are not really in your budget. Or if you're someone who has plenty of money and that $300 or $400 a month really isn't that big of a deal, you just don't want to pay it. Now we're getting into your money story and digging into the reasons of why this may be so concerning. Are you so dead set against having debt that is preventing you from looking for other opportunities that make the debt less of a concern? And that brings me to my next point. The alternative. What is the opportunity cost of putting the extra money down on the down payment, or by saving the money for the down payment and putting it in the market instead? Now, to be clear, you have to be very careful when you're using historical investment returns to justify a decision for how things are going to happen in the future, but it doesn't mean that you have to completely ignore them either. And in most interest rate environments, if you look at the historical returns of the market, especially over an extended period of time, putting money into the market is going to give you a higher, in many cases, a significantly higher return on investment as compared to paying extra on your mortgage. For our final example, using our mortgage of the day, we're going to look at what this person could have done with the $50,000 they saved by making a smaller down payment. So what you have on screen in front of you is an S&P 500 periodic investment calculator. Essentially, it allows you to look back through the history of the S&P 500 and give a projection of what you would have earned in the market based on the time that you invested. So we're going to go back to the same time they started this mortgage, June of 2016, and we're going to look at the end being June of 2026, 10 years down the line, and we're going to assume that they took that $50,000 they held back and put it in the market as compared to putting it on their mortgage. You'll be able to see that $50,000 that they put in the market in 2016 by 2026 grew to $202,845.95. That's an average annual return over that period of a little over 15% as compared to the 6.75% they were paying on this mortgage. And if you want to look at real dollars, if they decided to put this money on the mortgage on the front end, it would have saved them about $324 a month, which means that while it is true that over the course of 10 years, that's almost $40,000 more in payments they wouldn't have had to make, by putting that extra money in the market instead, they had gains in their account of more than $152,000. Now, there's a lot of things to be aware of with this. I have shared that I don't think that every investor should be in the S&P 500, so you have to take that with a grain of salt. And you have to compare it to what you might actually invest the money in. You might be a more moderate investor, and when you make that comparison, maybe the gap is not as large as it is in this example. You also have to be wary of using historical data to make future decisions. You don't want to just assume that the market will be better because we don't have that guarantee, no matter how much history we have at our disposal. But it's all a part of the factors that you use to make your decision. Remember, I didn't say that you should never put an extra down payment, even if your mortgage can be recast. I said it's important to know whether or not your mortgage can be recast so that it can be a part of your decision-making process. And not all mortgages can be recast. Many federally backed mortgages cannot be. But if you do ask this question and the answer you get is yes, plug in the numbers, ask your lender to run some scenarios, and at least consider my line of thinking. I'll see you next week. From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen.